Okay, what if, like, everything you thought about getting rich was wrong? It sounds a bit out there, right? What if the real difference isn't just how much you earn, but where that money comes from and what you actually do with it?
Yeah, that's a fundamental challenge, isn't it? The usual idea that just, earning a bigger paycheck is the way to go. It totally shifts the focus.
And that shift is exactly what we're digging into today. We're doing a deep dive into sources you sent us, our listener, specifically looking at parts of that really groundbreaking book, Rich Dad, Poor Dad, by Robert Kiyosaki.
Right. Our goal here is to unpack the main ideas, those contrasting ways of thinking, and honestly, some pretty surprising insights from these sources. We want to help you get your head around what they argue matters most for your own financial path.
And what makes this source so different right from the start is how it looks at things. It pushes back against a lot of common advice by comparing the guidance from two dads in the author's life.
Hmm.
You had his actual dad, highly educated, but, well, struggling with money.
Hmm.
And then his best friend's dad, a successful entrepreneur who didn't have that same formal education. This contrast, it's not just a story hook, it's really the core of the lessons.
Exactly. It sets up this really powerful framework. You're immediately shown two completely different maps for dealing with money and life, and it forces you to kind of compare them.
So the source kicks things off by introducing this exact situation,
Yeah.
having these two strong father figures giving him totally opposite advice about money.
And you see those differences laid out pretty quick. Like one father would say things like, the love of money is the root of all evil.
Wow.
And the other one hit back really directly saying, no, the lack of money is the root of all evil.
Quite a difference. And it went deeper than just sayings, didn't it? One was all about the traditional route school. Get a good job, learn how to write a killer resume.
Right. While the other was focused on, let's call it financial education, learning how to create investments, create jobs, learning how to write solid business plans, financial plans.
And the source argues that having these clashing viewpoints wasn't actually confusing. It was incredibly valuable. It made the author think, and it makes us think critically, weigh the different arguments, and ultimately kind of shape our own way of thinking about money.
Yeah, that process of figuring it out for yourself based on understanding these different perspectives, that's presented as way more empowering than just blindly following one set of rules.
Definitely. And speaking of rules, the source makes a really interesting point about why so many highly educated people, doctors, lawyers, accountants, even bankers can still end up struggling financially.
It suggests that, well, financial smarts aren't really taught in school. Schools focus on academic skills, professional skills, which are great for earning an income, sure.
But they don't necessarily teach you how to manage that money well or, and this is key, how to make it work for you. That kind of education, the source says, mostly happens at home, if it happens at all.
Right. Which is a pretty big gap.
Okay, so if school isn't teaching the crucial stuff, what does the source say is the absolute fundamental rule? Like the non-negotiable starting point for building wealth?
It basically boils it down to one simple principle. Rule number one is you have to know the difference between an asset and a liability. And then you focus on buying assets.
And the source really hammers this home, doesn't it? This is the only rule you really need to understand if you want to get rich.
Which, it sounds almost too simple, right?
Yeah.
But the source presents it as the bedrock, the thing that separates the wealthy from everyone else. And the definitions, just as straightforward. An asset puts money in your pocket,
Simple.
and a liability takes money out of your pocket.
It's all about the direction the cash flows, isn't it? The source uses those little diagrams to make it super clear. Can you describe what that looks like?
Yeah, exactly. Think of it this way. With an asset, like say a rental property generating rent, cash flows from that asset column into your income column. It's adding money. With a liability, like a car loan payment, cash flows out from your expense column. It's draining your money. That's the core difference.
So the fundamental difference in how people handle money, according to these sources, is huge. Rich people focus on getting assets, things that make money.
While the poor and middle class, often without realizing it, end up buying liabilities, things they think are assets that actually take money away from them.
And this whole cash flow idea, it's not just theory.
Yeah.
The source shows how it literally dictates your financial life. Your cash flow pattern tells the whole story.
Definitely. And it breaks down these typical patterns. For someone poor, the source describes it as pretty direct. Income comes in, usually just salary, and it flows right back out to cover expenses, rent, food, clothes, the basics, usually not much in the asset or liability columns.
Okay. Then the middle class.
That pattern, according to the source, is more complicated. and maybe, kind of surprisingly, often less financially stable. Income, again, mostly salary, covers expenses like taxes, housing, food, but it also has to cover significant liabilities, the mortgage, car loans, credit card debt. And the source points out, expenses and liabilities tend to creep up right along with income increases.
And here's where it really challenges that common thinking. It argues that for many middle-class folks, their house, which they see as their biggest asset,
Right.
actually functions more like a liability because it constantly takes money out every month. Mortgage, property taxes, insurance, upkeep, all that stuff.
Exactly. Now contrast that with the pattern for the rich described in the source. Money flows from their assets, businesses they own, real estate generating income, stocks, bonds, maybe intellectual property, into their income stream. Things like rental income, dividends, interest, royalties. That income covers their expenses, and this is important, the leftover cash often gets reinvested back into buying more assets. Their liabilities are kept pretty low compared to the income their assets generate.
This really sets the stage perfectly for understanding what the source calls the rat race. Can you break down what that means?
Yeah, the rat race. It's that cycle where someone, maybe in the poor or middle class pattern, tries to get ahead just by working harder at their job to earn more money. But the source argues that higher income often just triggers higher taxes, bracket creep, and usually leads to increased spending and piling on more liabilities.
So it's like being on a treadmill.
Right.
You earn more, but your taxes go up. You probably spend more, maybe a bigger house, nicer car,
Exactly.
which means more debt, more liabilities, and you end up just running faster but staying in the same financially shaky spot.
The source gives that classic example. A young couple gets raises. It's the first thing they do. Buy the dream house. Fill it with stuff. Get a new car, maybe. Suddenly, their liability column is just overflowing with debt. Huge mortgage, car payments, credit cards. They boosted their income, yeah, but they're actually less financially secure because their outflow, their expenses and liabilities grew even faster.
And the source makes the point that in this cycle, you're often busting your hump, working harder mainly for the government through taxes, the bank through debt payments, and your boss by making their business richer, not really for yourself.
Which leads right into the big strategic shift the source pushes for. To really build financial security, you've got to start minding your own business.
And that doesn't necessarily mean quit your job tomorrow, right? What does minding your own business actually mean here?
It means putting your main financial focus, your energy, your attention on building up your asset column. The source draws a really clear line between your profession or job, which is often essentially minding someone else's business,
Oh.
and your real business,
Right.
which is growing your own assets.
It argues that tons of people spend their whole working lives making somebody else rich.
So the strategy is keep the day job, at least initially, because you need the income,
Right.
but use some of that income and a lot of your mental energy to systematically buy real assets.
Precisely. And the source is specific about what it considers real assets, things that put money in your pocket. Businesses that can run without you needing to be there 24/7, real estate that pays you rent, stocks, bonds, notes, basically IOUs that pay interest in intellectual property, like royalties.
And that's contrasted with the stuff people often think are assets, but really aren't helping their cash flow. Like that brand new car that loses a chunk of value the second you drive it away.
Yeah, like 25% instantly, the source says.
Or just expensive consignor goods. Junk, as the source calls it, that just drain money and don't grow in value.
And there's a key point about luxuries, too. The source observes that wealthy people tend to buy luxuries last.
They build up their asset column first. Those assets generate income, passively usually. And then they use that income, the money their assets made, to pay for the fancy car or the big vacation.
Whereas the poor and middle class often do it the other way around.
Yeah.
Buy the luxury first, often on credit, using money they haven't even earned yet.
Exactly. Which might make them look rich temporarily, but it just digs them deeper into that liability hole and keeps them spinning in the rat race.
Think about that luxury car example again. The financially smart way, according to the source, isn't getting a loan based on your salary.
No.
It's buying assets first, maybe some stocks or a rental property, that generate enough passive cash flow to easily cover the car payment or even buy the car outright without touching your paycheck.
That's the fundamental difference in approach.
Okay, let's shift gears a little. One section in the source that often gets people talking, maybe a bit controversial, is about taxes. How does it frame the history and the strategy around taxes, especially for the rich?
Well, the source kind of frames the history of income tax as starting with the sort of Robin Hood idea. tax the rich to help everyone else.
Okay.
But it argues that as government spending grew, taxes inevitably spread to the middle class, becoming a major burden for people relying on salaries.
And how did the rich respond to this growing tax pressure, according to the source?
They adapted. They started using legal tools that had actually been around for ages, mainly corporations. Corporations were first popular for things like limiting risk on shipping voyages centuries ago, but they also turned out to have some pretty handy tax advantages.
What are the key advantages of using a corporation that the source points out?
It highlights two big things. First, the actual income tax rate for a corporation can often be lower than the rates individuals pay on their personal income.
Okay, that makes sense.
But the really big one, the one that changes the game according to the source, is the difference in cash flow timing regarding taxes. Can you explain that difference for an employee versus a corporation?
All right, this is crucial. As an employee, you earn your money.
Mm.
Then the government takes its cut first, usually through withholding taxes from your paycheck.
Mm-hmm.
And then you get to spend whatever is left over. So your pattern is earn face, pay taxes, spend.
Okay.
A corporation, though, it earns income, but it can legally pay its legitimate business expenses before it calculates the tax owed. So its pattern is earn spend on business costs, pay taxes on the profit that's left.
That's a huge difference in timing and what gets taxed.
And the source gives examples of things that can legally count as business expenses inside a corporation, things that an employee would have to buy with money they've already paid tax on. What were some of those?
Yeah, the source mentions things like vacations being structured as board meetings, paying for car expenses like payments, insurance, repairs if it's a business vehicle, even health club memberships or certain restaurant meals if they're for legitimate business purposes. These can potentially be paid with pre-tax dollars through the corporation.
This really drives home the source's point, doesn't it? That understanding these legal structures gives the wealthy a significant edge.
Yeah.
The force suggests that this ongoing tension, the haves versus the have-nots, often plays out in the realm of laws and taxes. And the people who lose out the most are often the ones who are uninformed, the hardworking poor and middle class who pay their taxes but don't really grasp the rules of the financial game being played at higher levels.
It's a strong argument for financial literacy for sure. Moving beyond those external rules, though, the source also digs into the internal stuff. What are the things inside us that stop us from building wealth, even if we kind of understand the ideas?
Yeah, it's not just about the numbers on a spreadsheet. There's this whole inner game. The source talks about several really powerful internal roadblocks. What's a major one it identifies?
Fear, big time. The fear of not paying the bills, fear of getting fired, fear of starting something new, and especially the fear of losing money. The source argues that just having more money doesn't magically make this fear go away. For many, it just keeps them stuck in that loop. Work harder, earn more, hope the fear disappears, but it often doesn't.
And there's also that fear of being different, right? Or being criticized if you try to step off the beaten path.
Absolutely. Then there's cynicism. What does the source mean by that here?
It's like that Chicken Little thing, always focusing on what could go wrong, letting doubts shut down possibilities before you even explore them.
Right. People jump to criticize, oh, real estate, too much hassle fixing toilets, or investing, too risky, what if I lose everything? The source basically says doubt is expensive because it paralyzes you and makes you miss opportunities.
It tells that story about the friend who almost did a real estate deal, but backed out because his neighbor, who knew nothing about investing, told him it was a bad idea. That really shows how listening to fearful, uninformed people can cost you, doesn't it?
Totally. The source pushes for analyzing things, look at the numbers, understand the real risks, but don't let knee-jerk criticism stop you. It even uses Colonel Sanders as an example, someone who faced tons of rejection but just kept going.
Laziness is another one, but the source says it's often disguised. How?
Yeah, it suggests that sometimes being incredibly busy working at your job can actually be a form of laziness because it keeps you from tackling the really important stuff like your financial education, your health, or building your own assets. You're busy, sure, but maybe not productive in the ways that matter most for your future.
This ties into that key principle the source promotes. Pay yourself first. How does that work, and why is it presented as a way to fight that kind of disguised laziness?
The idea is simple but powerful. When you get paid, you immediately set aside money for your asset column investing, saving for an asset before you pay your bills, rent, credit cards, even taxes beyond withholding. The source argues that the pressure this creates having less money left over after paying yourself actually forces you to get smarter and more creative. You have to find ways to generate more income or manage expenses better to meet your obligations. If you wait to pay yourself last, there's usually nothing left and no pressure to innovate.
Makes sense. And the final obstacle mentioned is arrogance.
Right. Arrogance here is described as often being a mask for ignorance. It's that attitude of, if I don't know about it, it must not be important, or dismissing new ideas because you think you've already got it all figured out. The source is blunt. Arrogant people don't learn much, especially from experts.
So the opposite is being humble and curious, right? Willing to listen, learn, even from people you disagree with, like those conflicting market experts.
Exactly. The source really values listening over talking, especially when you're trying to learn something new.
Okay, so if we can recognize these roadblocks in ourselves, how does the source suggest we actually move forward and build what it calls financial IQ? What's involved in that?
Financial IQ, as the source presents it, isn't just book smarts. It's more like a combination, a synergy of practical skills. It highlights 4 key technical areas. Accounting, basically, being able to read and understand financial numbers. Investing, the skill of making money make more money. Understanding markets, knowing about supply and demand, spotting trends, seeing opportunities. And the law, being aware of tax rules and legal structures to protect yourself and your assets.
Spotting opportunities sounds like a skill in itself. How does the source say you develop that?
It says great opportunities aren't just seen with your eyes, they're seen with your mind through knowledge and experience. He gives that example of the friend who bought the rundown house.
Oh, yeah.
He didn't just see a dumpy house. His financial knowledge prompted him to check the legal description, and he discovered the property actually included 4 extra valuable empty lots hidden within the single purchase. He saw potential others missed.
Raising money is another skill it really emphasizes, especially if you want to create investments, not just buy them. How important is that?
It's presented as absolutely crucial, especially for becoming what the source calls a B business owner or I investor type who actively creates deals. Learning how to get capital without just going to the bank for a loan is described as a priceless skill. The source flat out says lack of money stops most people, so learning how to overcome that specific obstacle opens up huge possibilities.
Management skills are also listed as key. What kind of management?
It talks about managing 3 main things: cash flow, understanding and controlling the money coming in and going out. Systems, it uses that famous McDonald's example. Maybe not the best burger, but arguably the best business system. And people leadership and managing relationships.
In tying a lot of this together, the source really hammers home the importance of sales and marketing skills. Why are those considered so vital?
The source basically argues that being able to communicate, negotiate, persuade, essentially, to sell yourself, your ideas, your products, is fundamental to success in almost anything. It uses that great line, best-selling author versus best writing author. You could be the most brilliant writer ever, but without sales and marketing, your book might never become a bestseller.
That's a good point.
The source even suggests you might be just one skill away from great wealth, and very often that missing skill is sales or marketing.
So instead of just chasing a slightly higher paycheck in your current field, the source encourages you to think about working to learn, right?
Exactly. It suggests maybe seeking jobs or even taking a second job specifically for the skills it teaches, not just the pay. Skills like sales, marketing, negotiation, understanding a particular industry. That education, even if it pays less upfront, is viewed as way more valuable long-term than just a small salary bump doing the same thing.
It compares it to starting exercise, doesn't it?
Yeah, like going to the gym. The hardest part is just deciding to start. But once you commit and start practicing these skills, it gets easier. You build momentum.
The source also mentions that tool the author created, the Cash flow game. What's the point of that?
It's described as a learning tool, like a simulator for personal finance. It's designed to teach you how financial statements work, how cash flows, how to spot different kinds of deals, and importantly, how to learn from making financial mistakes in a safe space without risking real money. It tries to engage you mentally, emotionally, even physically, as it mirrors your real-life financial choices and gives immediate feedback.
And finding guides is important too. Mentors and heroes.
Oh yeah, definitely. The source stresses learning from people who've already done what you want to achieve. Study their methods, see how they think, let their success show you what's possible and inspire you. Heroes make hard things look easier.
And finally, the source includes something maybe unexpected in a book about wealth, the power of giving.
Yeah, it talks about tithing or just being charitable, being generous with your resources, whether that's money or knowledge. The principle suggested is that by giving first, intentionally, you actually open yourself up to receiving more in return, and it can even make you smarter financially.
So the source does offer some concrete first steps, right?
Yeah.
What were some of those?
Things like find someone who's actually done what you want to do and just ask them for tips. Take relevant classes or seminars. Start making offers, especially in real estate. The source says you learn a ton just by doing that, even if they get rejected. Look for bargains. Buy assets when markets are down or things are on sale. Think bigger, even if you start small. And keep learning from financial history.
Okay, stepping back a bit, how does the source ultimately define wealth and financial independence? It's clearly not just about having a big pile of cash.
No, not at all. It uses Buckminster Fuller's definition of wealth, which is pretty interesting. It's measured by how many days you could survive financially if you stopped working today.
So it's a measure of time based on
Oh,
cash flow.
exactly. It's dynamic. It's about how much cash flow your assets generate compared to your monthly expenses, not just a static number.
Which is really different from net worth, right?
Right.
That's just assets minus liabilities.
Right. Net worth can include stuff that doesn't produce any income, like maybe your fancy car or expensive furniture, and it's often based on subjective values. The source's definition of wealth is purely tied to sustainable incoming cash flow from assets.
So the goal of financial independence then, according to the source, is simply reaching the point where the monthly cash flow coming in from your asset column is enough to cover all your monthly expenses.
That's it. At that point, you're no longer dependent on a paycheck from a job to live.
And the strategy to get there, or just increase your wealth, becomes really straightforward. Focus on increasing the positive cash flow from your assets. If you want to spend more, the approach is, first, increase your asset cash flow to cover that new spending comfortably.
It flicks the usual script of earn more to spend more.
Towards the end, the source also connects financial freedom to something maybe deeper, finding your life's path.
Yeah, it brings in that quote from Thich Nhat Hanh, the path is the goal. The idea being that while money freedom is great, the ultimate aim might be finding your real purpose, which isn't just your job title or your bank balance.
And it argues that traditional school, while prepping you for a job, often as an employee or self-employed S person, doesn't really equip you for that kind of self-discovery, or even for handling the ups and downs of real-world finances. Finding that path takes intuition, guts.
And this connects back to that idea of holistic education. The source suggests that to be a fully functional, whole human being, you need to develop mentally, physically, emotionally, and spiritually. Traditional schooling often hits the mental part hard, but might neglect the others, which could explain why some academically brilliant people struggle with fear, risk, or making sound financial choices. The emotional or spiritual pieces might be underdeveloped.
And those emotional and spiritual aspects are positioned as really key for making lasting changes in any area, right? Like finance or diet or breaking bad habit.
Exactly. The source suggests that supportive communities, like the cash flow clubs it mentions, can help with that broader development, letting people learn and grow at their own speed.
Finally, just to tie some threads together, the source briefly introduces the cash flow quadrant idea, categorizing people by how they primarily earn their money. E for employee, S for self-employed, B for business owner, and I for investor.
Right. And while it says you can achieve financial freedom from any quadrant, it strongly suggests that developing the skills and mindset of the B, business owner, or I, investor side, can get you there much, much faster.
Even successful employees usually need investor skills for a secure retirement.
Definitely. It uses that really simple but effective analogy to show the difference between the left side E and S and the right side B and I. The story of Ed and Dill delivering water.
Tell us that one quickly.
Ed was the bucket carrier. He traded his time and effort directly for money, haul a bucket, get paid. If he stopped hauling, the money stopped. Classic E or S pattern. And Dill? Bill took a different approach. He invested time up front to build a pipeline, a system. Once the pipeline was built, it delivered water and generated income, whether Bill was actively working that day or not. He built an asset that created passive income. That's the core difference between trading your time for money and building systems or assets that make money for you.
Okay, so if we're wrapping up this deep dive, the core message from these sources seems pretty clear and honestly, for a lot of people, a total rethink. Financial intelligence isn't really about how much you make.
No, it's about what you do with the money once you get it.
It's fundamentally about understanding cash flow, knowing the real difference between assets and liabilities, and focusing on assets. It's about protecting your money legally and tax-wise, and ultimately learning how to make your money work hard for you instead of the other way around.
Yeah, and that common saying, it takes money to make money, the source basically dismisses it. It argues building wealth starts with changing your thinking, getting financially educated, acquiring skills. Money itself is just an idea, a tool.
The encouragement seems to be get proactive, commit to learning constantly and taking action. Start small, practice, read, take classes, find mentors. It gets easier as you go, right?
Absolutely. Practice builds competence and confidence.
And the source leaves you with that really powerful, simple thought. It's what is in your head that determines what is in your hands. Learn to make money work for you, and your life can genuinely be easier, maybe more fulfilling. Don't just play it safe, play it smart.
So, based on everything we've chewed on from these sources today, here's maybe something for you, the listener, to reflect on. Take an honest look at your own cash flow right now. Are you mostly bringing things into your life that consistently put money in your pocket? Or are you mostly acquiring things that take money out? And maybe think, what's just one small, doable step you could take this week, starting now, to consciously begin shifting that pattern more towards building your asset column?